Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. My name is Lauren Templeton, and I'm your host on Investing the Templeton Way podcast. I have an exciting guest here with me today. His name is Jeff Stacey. Jeff is the founder of Stacey Muirhead Capital Management, located in Waterloo, Ontario, Canada. Welcome, Jeff.
Thank you. It's a pleasure to be with you today, Lauren.
Yeah. So before we get started, I should just note that I know Jeff and first met Jeff through the Fairfax Financial annual meetings, where I'm both a shareholder and serve as independent director. I'm also a shareholder and independent director of Fairfax India. In these discussions, those two businesses might come up. So in full disclosure, I'm both director and shareholder of those businesses. Also, in the event that Markel or Berkshire Hathaway comes up in the conversation, I'm just trying to anticipate, Jeff. I'm also a shareholder in both of those businesses. So welcome, Jeff. And like I said, I first met you at the Fairfax Financial annual meetings years ago. And I think I last saw you in Richmond, Virginia at the Markel AGM. Did you complete, as Bob Robotti says, the triple crown of AGMs last year?
I did not. I missed the Berkshire Hathaway annual meeting for the first time since pre-pandemic. I had gone, 28 years in a row. Of course, 2 years we were forced to attend virtually. And then this past year, I was not able to attend live for personal reasons, but look forward to going back next year.
Oh, good. I was just looking at hotels yesterday, and they're booked. So I will see you there in May. Clearly, you were drawn to this business model, Berkshire Hathaway, Markel, Fairfax Financial. Walk me through what attracts you to these businesses.
Well, simply put, when we're looking at any long-term investment opportunity, we want a good business, as evidenced by, great business economics. We want it to be run by good people who are honest and capable and talented and importantly think and act like owners. And so we certainly look for managers to have skin in the game. And then, we want it to be available at an attractive price. And so at the big level or big picture level, certainly all three meet those criteria. From the point of view to drill down a little further, insurance can be a great business because if you underwrite wisely, meaning at a combined ratio below 100, you can earn underwriting profits, but you also get the use of that capital until claims need to be paid out. And so you can use that float to make other investments. And so we just like the attributes of property and casualty insurance companies if they're well run. And there's not a lot that are. And certainly Fairfax, Markel, and Berkshire have stood the test of time in that regard.
Right. A well-run insurance business can have a negative cost of capital, which is always an attractive quality. These businesses have similarities, but differences too. How would you compare and contrast the three businesses, Berkshire, Markel, and Fairfax?
Well, that's a great question. So to start and state the obvious difference, Berkshire Hathaway and Warren Buffett has been running Berkshire Hathaway a lot longer than Markel and Fairfax have been public. So that's the one major difference. I would say, so Berkshire today clearly has more of its assets allocated outside of insurance and has been consistently over the years buying companies, private businesses that they want to own. Markel's probably in the middle of that spectrum. They're Markel Ventures arm, so they still have a higher exposure to property and casualty insurance than Berkshire, but they're well down this path of buying private businesses that become available at attractive prices. The one comment I would make about Markel specifically is because they're smaller than Berkshire, they're getting opportunities to add private businesses that are very attractive, but yet meaningful to Markel, whereas those businesses wouldn't move the needle at all at Berkshire. And then Fairfax, similar to Markel in my judgment in many ways, but I think one of the things that has distinguished Fairfax is they've been very opportunistic in capital markets. So meaning, they will also sell some things if it makes sense to do so because the price is attractive. And so they're a little bit more opportunistic. Certainly on the fixed income side, they've shown more of a propensity to both go long in duration when they thought that was the right thing to do, or to go very short in duration, which is where they've been presently, whereas compared to, say, Markel's kind of kept an average duration of 3.5 to 4.5 years, or tried to match their fixed income portfolio to the insurance book. So in a broad sweep, that's how I would kind of describe the differences between the three.
Thanks. That's a really good description. And I'm assuming that you still own all three stocks in your portfolio?
We do.
And do you consider yourself a long-term owner of these positions?
Well, we've owned Fairfax and Berkshire since the 90s and Markel since the early 2000s. So it's 2022. By my definition, in any event, that's a long term, and we have been long term holders. Now, we have from time to time both sold and purchased shares in all three through that time period, but we certainly have always had an investment, as I say, for Fairfax and Markel since, actually Fairfax was in 1989, we made our first investment, but Markel or Berkshire shortly thereafter, and then Markel was in the early 2000s.
Okay, so Fairfax was the first investment.
Yes.
That's very interesting. Well, the CEOs of these businesses, in case my listeners don't know, are Warren Buffett, Prem Watsa, and Tom Gaynor. What have you learned from these investors, and how has it shaped your investing at Stacey Muirhead Capital Management?
Oh, wow. That's a great question. There's a lot to unpack there. Well, first and foremost, I just, all three individuals have outstanding character, and they're motivated to do the right things for their shareholders because they are in fact shareholders. But I think the biggest trait, it's just this character trait, this honesty, humility. Those are, I think, the things that are universal among all three. And then, in terms of lessons learned, always trying to absorb what all three investors are doing and where they're committing their capital, and what can you learn from how they're committing their capital at any point in time that will make you a better investor.
Yeah, I mean, I agree. I have learned a lot from all three of these gentlemen as well. Tell me a little bit about attending the annual meetings and if there's one in particular that sticks out to you. I know you always do the fireside chat the evening before the Fairfax financial meeting, which is always interesting. But is there an annual meeting that really sticks out to you that's very memorable?
Again, good question. I hadn't really thought about that. I think, I think for me, certainly I go to the meetings for what I'll call the direct learning experience, hearing from Prem or hearing from Tom or hearing from Warren. But I think the other benefit for me of going to the meetings is the indirect learning. So all three of these meetings are a money manager convention, if you will. And, just being able to interact with so many wonderful and high quality investors has been for me something that's just really aided my learning, and the close professional and personal friendships that have developed from all three meetings are just something that's been very beneficial and very valuable to me.
Yeah, I agree. So last year I attended all three meetings, and each one is a little different for sure. And Fairfax Financial AGM is in Toronto. They're all in the spring. And Berkshire Hathaway, of course, is in Omaha, Nebraska. And Markel has its annual meeting in Richmond, Virginia. I agree with Jeff that everyone there is really, it's just a nice group of people. And there is a lot of exchange of ideas, and it's a friendly group. So do you think that's unique to value investors? Do you think value investors are just kind of a friendlier group of folks, or are they more down to earth? Or what do you think the culture of value investing is, and why is it like that at these meetings?
My friend Tom Russo says that value investors are just nicer people. So I don't know if that's true or not, but I guess it's just this commitment to always getting better. And my experience is that investors who show up at any of those three meetings, and there's a large component, including you and me, that goes to all three every year, although I missed Berkshire last year. And I think it's just this common bond and commitment to getting better at investing and getting better at being a good, productive citizen in this country and a good person. And are value investors nicer people than other investors? I don't know, Lauren, but I just know that the investors that go to any of those three meetings tends to have this mindset of wanting to learn collectively, and maybe that goes back to some of the humility traits that I was talking about before. I think value investors have maybe been beat up a little worse than other investors over the last decade. So maybe there's a more willing, or just a necessity for humility, and a need to be committed to lifelong learning. So that would be my take on it.
Yeah, I agree. Lifelong learning. I leave these conferences. I'm so inspired every year when I leave to become a better person, to become a better investor, to be a better daughter, to be a better mother, to be a better friend and colleague. So I do think there's clearly something in the air. And I would say a lot of that could be attributed to the leaders of these organizations, because they themselves embody this humility and lifelong learning, as you say. So I would encourage everybody to attend. I've heard you talk a lot about how at Stacey Muirhead Capital Management, you look for great businesses, great people at a great price. So that's the way you look at it, investing. So if Markel, Fairfax, and Berkshire are great businesses because of their business model and this property casualty insurance business that generates float, which can be invested, and it seems that you think they're run by great people, are they currently trading at a great price?
Well, the answer is yes. And let me try and unpack that a little bit. So all three CEOs of those companies have stated that, over time, the important, or book value as a measure of intrinsic value is becoming less and less. And while I certainly agree with that statement, I still think book value can represent a rough proxy or a starting point, if you will, to think about intrinsic value. So today, Fairfax trades at a discount to its stated book value, and Markel and Berkshire trade at what I would deem to be very modest premiums to book value. So if you believe that, all these holdings, and I'll use Berkshire because it's been around the longest, they bought See's Candies in 1972, and, it's on the books for X. But clearly, if you were to sell that business, it's worth 4, 5, 6x, possibly more. So, when I look at book value, I'm saying, okay, that's including things like See's Candies at X, when I know it's worth a lot more than X. So to be paying, 1.2, 1.3 times book value for Berkshire or Markel, I still consider that to be a very attractive price. And of course, Fairfax is a little bit of the outlier in that regard, in that it's still at a discount to book. Now, Fairfax has been performing very well recently. It's performed well long-term, but it's performed very well from a business point of view recently. And, the share price has moved up somewhat to reflect that, but I still think there's a significant discount.
Yeah, I obviously own all three shares as well: Markel, Berkshire Hathaway, and Fairfax Financial, and we have owned them for some time. So I agree with you on many of those points. Do you still have an allocation to Fairfax India?
Yes, I do.
Okay. I was just going to disclose again that I own shares of that, and I'm on the board of Fairfax India. Jeff and I actually we were talking about it before the podcast started, but in January of 2019, we were on a very special trip of institutional investors organized by Fairfax India, where we traveled all around India and had some great food, met some great people, and learned a lot about Fairfax's businesses in India, as well as a lot about the country. What did you learn from the trip, and what did you take away from the trip to India, Jeff?
Well, the opportunities are huge. That would be the first point. Growth in India, the increasing levels of income and the number of people moving into the middle class. So, the big picture things are very positive about India over the long term. You were there, so as you well know, one of the biggest holding of Fairfax India is the Bangalore International Airport. Toured the facility. I believe just last week, the second terminal opened. This is the airport in so it's southern India's largest airport. It's the third largest airport overall. It's growing quite dramatically with we have to kind of draw a line in pre-pandemic and post-pandemic. And, the assumption you're making is that at some point we're going to get all the way back to normal in terms of passenger counts and freight counts and all those things. But, so you have a business in Bangalore Airport that, has expanded its passenger counts quite dramatically, expanded its freight business quite dramatically over the last several years, but yet Fairfax India was able to purchase it at quite a significant discount. And, if you look at comparables around the world, and, the airport in Sydney, Australia just recently was taken private by a group of infrastructure funds. And, for modestly more passengers, it was valued at 6 to 7 times what the current valuation on the Bangalore airport is. And then the one offset, the Bangalore airport also has excess land, or more excess land than the Sydney Australia Airport has, and that's being developed over time. So that's a further value creator at the Bangalore Airport. So, my takeaway, I thought Fairfax Fairfax India is well respected within the country. They've got a good team on the ground. I think they've made some very, very attractive investments. And there again, just using book value as a rough proxy. And I would argue in the case of Fairfax India that it's a closer proxy than even book value for Fairfax or Berkshire or Markel. But again, recognizing it as a rough proxy, you're trading at a roughly, about a 40% discount to almost 50% discount to stated book value at the end of the last quarter. And that's recognizing that their largest asset is being valued at a very reasonable valuation, in my opinion.
Yeah, I've recently seen pictures of the new terminal. I have not visited the new terminal, obviously, but have recently seen pictures, and it's absolutely breathtaking. It is really a beautiful, beautiful terminal, and I wish we had something like that here in the United States. It looks a lot nicer than LaGuardia or Hartsfield Jackson International in Atlanta, for sure.
And Lauren, as you well know from being there, admittedly before the second terminal was built, but when we were there, I was always struck by what a sustainability story it is. Well, like there's no waste of water, they're recycling water. There's a big solar energy component. They've done a marvelous job in terms of building a modern airport to serve passengers and freight, but doing so in a way that's highly sustainable and unlike anything I've seen anywhere else.
Yeah, the new terminal also gives you that vibe as well. So, yeah, I agree. So are you bullish on India over the long term?
Yes. And, there'll be bumps along the way for sure. Nothing straight up, but, I just think the country's on the move from GDP growth and income levels increasing. And, I think there's been a commitment to, one of the problems in India historically has been just mind-numbing bureaucracy in terms of getting approvals to do just about anything in the country. And although they still have a long way to go, they've also come a long way. And, they're scoring, at one point they were well over, the 100th worst country in the world, and now I think they're somewhere around 70 in the latest surveys, which I think are conducted by the World Bank. Don't quote me on that. I think it was the World Bank that puts that annual survey out, but wherever they are in that number, they've come a long way and they're committed to going even further. So, I think there's just a lot to like about the country.
Is Fairfax India the only position? Is that how you're playing India, or do you have other positions in India?
At present, it is the only way, other than perhaps through some large multinationals having an exposure. So we own, for example, Diageo, which has a big presence in India, but Fairfax India would be the only direct way. I really used the 2019 trip as well as a way to start getting more engaged in the country. And although we haven't done anything directly yet, it's certainly on our radar screen.
Yeah. So tell me about your portfolio. It sounds like it's global. And how many positions do you have?
Right now in the main partnership, we're at about 30, which quite frankly is a little higher perhaps than we would like it. I think, 20 to maybe 22 is the perfect number. And so we've got a few smaller positions. But from a big picture point of view, we try to do two things for our investors. So this notion of a limited number of long-term investments like we have been talking about with Fairfax and Markel and Berkshire and Fairfax India. And then we will also participate in event-driven investments. And so that's the pursuit of profits from announced corporate events. And so there are a number, mergers and acquisitions, liquidations, spin-offs, things like that can create opportunities in markets. So we have historically devoted at least a portion of our portfolio to that activity. There's no stated number or allocation or percentage that we allocate between the two. We just, try and look at things opportunistically. And so, we've been zero in event driven. We've been at our peak, I think 45% in event driven. And so, that gives you a sense of how things move around. But that's the way we think about those two activities form the primary part of what we do, or the cornerstone of what we do for our investors. So, some examples recently on the event-driven front, Citrix Holdings was taken over by Elliott. Nielsen Holdings also taken over by Elliott and Brookfield. Those are two recently completed transactions. We own shares in Tenneco, which is being taken over by Apollo. That transaction should close sometime in the next week. And so, you're hoping to set up, maybe a 5 to 10% spread, let's say, but your money's only out at work for a short period of time, say, anywhere from 1 month to, probably 1 year, but 3 months on average. So if you're getting a 5% spread in 3 months, that basically works out to a 20% annualized rate of return. And so you have to have a high batting average in event driven, because when you stub your toe, it's not fun. And usually there's more downside than upside in event driven investing. But you also have a higher probability of success. And we like event driven investing because it just gives you another page in your investment playbook, if you will, and you don't have to, if you can't find things to do on the long-term investing side, maybe there's opportunities in event-driven that are better than just leaving your money in cash. So that's a little bit how we think about it.
Yeah, I see. So I would assume that if you're an event-driven investor, you're less correlated with the market, right? It's not as dependent on the direction of the market. You're just looking at these specific opportunities to invest in. And do you see an uptick in potential event-driven investments over the next year or two as companies either try to deleverage or unlock value in a slowing environment?
Possibly. I mean, I would say we have had a pretty robust environment.
Yeah.
More driven by low interest rates, so that makes the cost of acquiring something easier for the acquirer. We'll see how things unfold. I mean, certainly slowing business conditions may create opportunities for spin-offs, those sort of things. But, on the merger and acquisition front, interest rates are increasing, so that's maybe an offset. But, we just put one foot in front of the other and try and look at the opportunities that are out there that have an event-driven aspect to them. Certainly Warren Buffett commented at the annual meeting this past year, they've taken a position in Activision Blizzard, which is subject to a takeover by Microsoft. And, the spread is quite large because there's concerns about, big tech generally, but in this case, is the transaction anti-competitive? We'll see. And, as an arbitrager or an event-driven investor, you sometimes you'll get surprised. From my personal perspective, I just don't see how it is an anti-competitive transaction when, they will be anywhere from the third to the fifth largest player after the transaction closes. So there's going to be larger players out there. Gaming is very competitive with many different platforms and developers. And so from my chair, it's not anti-competitive, but of course, whenever you have politics and government involved in things, there's certainly a risk there.
Yeah, you just don't know. And I think Buffett says when evaluating these opportunities that you've got to think about the probability if the event will occur, how long your money will be tied up, what the downside is. So is that how you sort of think about these opportunities?
Absolutely. Yeah. I mean, what I kind of like about the Activision Blizzard transaction, and others are free to disagree with me on this, but I kind of like the upside downside relationship. So, if the transaction's approved, clearly we're going to get, $95 a share, and, we'll get that. They're projecting by June of next year at the latest. So, the shares are 74. I'll leave it to your listeners to do the math on that one. But let's just assume that, the antitrust regulators in some country or another refuse to approve the deal. Like, I would argue the downside is somewhat limited. And what I found very interesting about the Berkshire Hathaway involvement in Activision Blizzard is they were actually buying it last year, well before any discussions started about the takeover between Microsoft and Activision. And, the price they were paying was kind of around these levels, actually a few dollars higher. So here you have a buyer, Berkshire Hathaway. Yes, they can make mistakes like any of us can, but clearly they have a great long-term track record. And so they liked Activision Blizzard as a long-term investment in the 70s. And then along comes the transaction, of course, 95 on the table. Then Berkshire added to their position. And Warren Buffett was quick to point out that at that point, they were viewing it differently, and that I think, the phrase he used was when a takeover happens or gets announced, it becomes a different type of security. And so in this particular case, I just find it interesting. I think, I'm not saying the share price won't decline from here if the deal does not go through, but I think you can make a case that it's a reasonable investment proposition as well.
Yeah, I remember all of those discussions at the AGM last year. I've heard you say that your investments fall into 4 categories. You alluded to that just a moment ago. Long-term investments, which would be your Berkshire Hathaway, Markel, Fairfax Financial, et cetera. Event-driven, which could be between 0% and a larger percentage of your portfolio. Other commitments and cash. So what would other commitments be, and how do you use cash in your portfolio? What is the purpose of that?
I believe that most of our activity over time will be long-term investments and event-driven investments. We have that third bucket, other commitments, because we just don't want to limit ourselves. So if there was an investment opportunity that didn't neatly fit into either of the first 2 buckets, but we can understand it and we think it has attractive risk-reward characteristics and good return potential, we want to have the flexibility to be able to do that. So one example would be distressed bonds, either those that are still paying but are, a long way from par or priced below par because there's fears that they're going to be able to continue to pay. And so we might do the analysis and say we're reasonably comfortable that they can continue to pay. And so we would make an investment there. Conversely, we might buy something that's already in default as part of and hoping to end up with a payout of some cash and some new securities in that company. But, if you're paying, and I'm just pulling out a number here, 20 cents on the dollar, and you end up with 50 cents on the dollar through some, cash payment and some new securities, that can be an attractive investment return. And then cash is the default position. And the only thing I will say there is, so if we can't find enough opportunities in bucket number 1, number 2, and number 3, we will let the cash build up. But a subtle, but I think important distinction about cash is it's not a market timing call. In other words, we don't say, let's go to cash because we think the market's too high. And, we just let the process drive that. You may end up in the same spot. We can't find enough things to do because securities are not priced properly. And there's just not enough opportunities for us, and the market's de facto too high. But it's not a market timing call. It just happens through the sifting and the evaluating process, and where we can't find things to do that make sense to us, we'll let the cash build up.
Yeah, I understand that very well. And we have the same, we're similar here at Templeton and Phillips Capital Management. I think many other valuation-led managers would answer the question in a very similar way, that cash is organic to the investment process. Like, I always say I've never met a good market timer. My uncle was Sir John Templeton. He wasn't a good market timer. He said he was right only 60% of the time, which is kind of depressing to think about. If he was right only 60% of the time, that means the rest of us are right a lot lower percentage than that. But yes, we are similar. So when you're talking about discussing distressed credit, we haven't seen a default cycle in many years. So do you anticipate that you're going to be more active in this area going forward, or just wait and see what opportunities are out there?
It's opportunistic. I mean, maybe I can answer the question in a backhanded way. We have no other commitments in our portfolio at the present time. Yeah. Now, a year from now, who knows, right? And certainly, I mean, if interest rates continue to go up or stay elevated, whatever that means to your listeners, it's not inconceivable that some companies might run into difficulties. And so that might lead to some opportunities.
Yeah. Well, there are plenty of opportunities out there in the market, I think, right now, with the markets being down about 25% on the year. Are you close to fully invested? Are you embracing this market as an opportunity? Or are you more defensive?
We are certainly finding things to do. We are close to fully invested. And maybe to illustrate the ebb and flow between long-term investments and event-driven, we have had in the last, year to 18 months, a pretty large exposure to event-driven. And by large, say, 20 to 25% of our portfolio. As those have rolled over and reverted back to cash, we're tending to deploy that more to long-term investments right now. And, if you can get it working perfectly, that market insulating benefit of event-driven helps you when stocks are going down. And then, you have the cash available because the transactions have come to fruition. The event-driven transactions have come to fruition. And now you have securities, lots of opportunities on the long-term investment side, either to add to existing holdings or to purchase some new holdings that you've followed and monitored and researched and that are now lining up from a valuation perspective to make them attractive. Of course, things in reality don't always work out that smoothly, but that's part of if you get it working well, the interaction between the event-driven component and the long-term investment component.
Yeah, I like the way you structure your portfolio. I'm not surprised to hear you say that things don't always go as planned. I think after working in the industry for more than a few years, yeah, I'm still always surprised at what can happen. So you've been in the industry since 1994. I think you said you launched Stacey Muirhead Capital Management.
Yeah, and was a broker on the sell side for about 8 years prior to that. So.
Okay. And so how has your style evolved over time, and what has influenced you most?
Well, I would say the basic planks haven't changed, or the basic framework hasn't changed. I would certainly hope that we're improving and getting better year by year at analyzing and researching and taking that data bank of experience and not making the same mistakes over and over again. But I wouldn't say the basic framework has changed at all. And, when I was starting out in the business, I remember going to the Templeton Growth Fund annual meetings and was greatly influenced by your great uncle, Sir John Templeton, and, read everything I could find about him and his investment approach and process. And certainly I know you and Scott wrote an excellent book, and Scott did a edit on the Templeton Touch. And,
Yes.
Those are great reads. And then I was also influenced by Sir John's writing in other areas, the Templeton Plan, Riches for the Spirit, Worldwide Laws of Life. And so been greatly influenced. I mean, obviously we've talked a lot about Warren Buffett and Prem Watsa and Tom Gaynor. They've been wonderful friends and supporters of our firm, and have had wonderful conversations over the years. I mean, not so much with Buffett, obviously, but with Prem and Tom and Steve Markel. So it's just I enjoy the process. I enjoy the grind of research, and you're just always trying to get better at the craft of investing.
Oh, yeah. Well, thank you, Jeff, for mentioning our work. And also thank you for remembering my great uncle, Sir John Templeton, who, I loved. He was my mentor, and it always touches me to know that people still remember him and his contributions to the industry. And certainly I think that, Warren Buffett and Prem Watsa, all these gentlemen have a lot in common with John Templeton. They all remind me of each other in so many ways. And I do think the value investing community has such a quality network of individuals, whether those are the CEOs of these companies or their underlying investors. So I want to ask you just a little bit right now about your perspective on investing in the U.S. Do you have a lot of investments in the United States? Do you think it's a good time to invest in the United States, or are the politics scaring you?
Well, yes, we do have our largest portfolio component would be in the U.S. We would be and not that we spend any time really thinking about this, but compared to, say, the Morgan Stanley World Index, we would be underweighted in the U.S. But that's not, again, that's probably a bottom-up reflection, if you will. Just we found some interesting opportunities in other geographies. No, I'm not afraid to invest in the United States. Politics ebb and flow, and yes, as a Canadian, I'm not sure that I should even comment on U.S. politics. But and by the way, we have our issues in Canada as well. But
Yes.
Politics ebb and flow, and things evolve over time. And I don't have any particular comment on the midterms other than to say that I think the best governing probably happens when the White House is different from the House or the Senate, and I know the Senate looks like it's going to go Democratic, but the House, I think, is likely to go Republican. I don't think they've gone over 218 yet, as far as I know. But, so I think that can lead to good governing. But most importantly, I guess I just come back. We try to tune out all that noise, and we're opportunistic, and we're just looking to find, either great long-term investments or event-driven investments that we think have a high probability of happening, and as low a risk profile as is possible. I mean, I didn't touch on, I mean, we're doing a few more things in small caps. And so, one of our luxuries, I think, as a smaller firm is that we can look in the small cap space. And, there's things I, kind of don't want to name names in small
Sure.
caps, but, there's things that are trading at, clearly low single digit earnings and cash flow multiples that are growing top line and bottom line, that have balance sheets that have, net cash. So, there's always something to do. And, all countries, all nations go through their issues, but I think the U.S. is going to be an attractive place to invest for a long, long time.
Yeah, there's always something to do. That is one of the name of one of my favorite books on Peter Cundall.
Yeah.
So
Yeah.
that's interesting.
Yeah.
So I'm going to close the interview by just asking you a few questions that I always ask my guests, because I get really fascinated about how people organize their day, their life. I feel that I'm always lacking in the time department. I'm busy. I've got 2 kids, and I think, how do people do this? So if you don't mind, I'll ask some personal questions about, like, what does your daily schedule look like? What time do you wake up? When do you do your reading? What are you reading? Have you read anything interesting lately?
Well, I'm a morning person by definition. So I find I'm more productive in the morning. So certainly I do more reading in the morning. In terms of organizing my day, like everyone, I battle the same things that you do, Lauren, and, I'm not trying to hold myself out as being expert at organizing my day. But I will say this, I do think a lot about eliminating distractions. I do think I'm getting better at saying no to things as life goes on. So, just simple things like, while I have a computer screen in my office, I really make a conscious effort not to be fixated to stock market prices and, what's going on moment to moment. Certainly emails can suck a lot of time. So I just, I have all the noise indicators that a new email has come in are shut down. I try to kind of pool my emails once or twice a day to respond to them. I just feel that makes me more effective. And, I also just try to tune out the noise as much as I can. And, I think it was Lou Simpson that said something to the effect, and this isn't an exact quote, but, I try to spend more time thinking than acting. And, so that's certainly a kind of a mantra that I try to carry around. So I don't have any particular secret sauce to impart in that regard, other than, I think if you think about it and you kind of carry it around with you, you can take some actions that can be helpful. Maybe don't get you to perfection by any stretch of the imagination, but that can be helpful to, being more productive.
Well, thanks for sharing that. Have you read any interesting books lately, or anything that has really stood out to you?
I'm about halfway through Maggie Hagerman's book about Donald Trump at the moment. I mean, certainly in the last, over a longer period of time, 2 books that really, really resonated with me and I would recommend to anyone is the William Green book, Richer, Wiser, Happier, and The Psychology of Money by Morgan Housel. I mean, I think they're both wonderful, wonderful books. And so those are 2 that leap to mind. I mean, I'll maybe back up and say I try to read a lot. I'm trying to spend as much time as I can on books that I'll loosely call behavioral finance, where what are the tricks that we all, the traps and the tricks in our behavior that we don't recognize we're doing them, but, they limit your investment performance, or they limit your productivity and effectiveness. And so I try to, there's been a number of books in that regard.
Well, we certainly have that in common, because I like those books too. James Montier has some great books on that subject. And I'm glad that you mentioned William Green's Richer, Wiser, Happier. I was corresponding with him last night, and we're recording an episode of this podcast in the next few months with William. And then with Morgan Housel's book, The Psychology of Money, it is one of my personal favorites. And on Sunday night, I went to speak to a group of young women, all high school students, who run an investment club here locally. And that's the book I took. I took The Psychology of Money and said, here, this is a great place to start. It's a very interesting read, and for well-seasoned investment professionals as well as beginners. So, and I think, Jeff, I wanted to share with my audience, if you don't mind, that you have also, you play the drums. That always surprises me about you. For some reason, I have a hard time envisioning this. But so what type of music do you play when you play the drums?
Well, so I should back up. I played the drums in my teens, and, played with a bunch of guys on weekends, and we eked out some spending money playing at various locations. When I went away to university, my drums went away, and I didn't have them out since then. And about 4 or 5 years ago, I just had a hankering to try. Of course, needed to buy a new drum kit because my old kit was warped and in horrible condition from sitting in the basement for 30 odd years or 35 odd years. In terms of what I like to play, I know some other musicians who are professional musicians, and they're kind enough to let me sit in from time to time and play a few songs. Of course, the pandemic has limited a lot of our ability to play music live, but it's slowly coming back. And, my personal tastes probably lean towards, on one hand, classic rock, and on the other hand, enjoy playing in situations where you have the old jazz standards are a lot of fun for me as well. But so it's an interesting hobby. I'm glad you clearly flagged that one as the outlier. The rest of what I do is sort of the normal, fitness, reading, hiking, playing golf occasionally, poorly, I might add, and traveling. But playing the drums is the outlier.
Well,
now,
I love this.
Yeah. So people say that, playing drums helps, sort of your mathematical skills. I don't really know if that's true or not, but, maybe I should play drums more frequently and it would help my investment performance. I don't know. I've
heard somebody talk about the mathematics behind music. It might have actually been Tom Gaynor. I don't know why I think that was who talked about it. I could be completely wrong. But the next time I visit with you in Waterloo, I'm definitely going to have to take in a performance on the drums. So you'll have to invite me to see that.
Be careful what you wish for, Lauren.
I know. I will be very careful. Well, Jeff, I know you're a busy person and you're learning to say no. Thank you for not saying no to me and for spending an hour of your time with me today. I'm sure that my listeners have learned a lot from you, and I just want to express my appreciation for this time.
Oh, Lauren, it's been great. And I just want to return I think what you're doing with these podcasts and writing about Sir John and the perpetuating his legacy is just wonderful. And please keep going, because there's a lot of wisdom that can be tapped from the life and teachings of Sir John Templeton.
Well, thank you, Jeff. Thank you for listening to Investing the Templeton Way. Please be sure to subscribe on your favorite podcast player. To view the show notes and resources mentioned in today's show, head to investingthetempletonway.com.